Hello everyone, welcome to Bald Guy Money. I am Bald Guy, and last week I did a video about Germany where I discussed their recent struggles and why I thought they were the architects of their own demise. And in that video I said, even as gold was pulling back, that you can be sure no matter where you are in the world that more record gold prices were coming in 2025 as countries desperately try to stimulate their failing economies. And sure enough, it didn't take longer than the first week of the year for gold to make a new record high in Australian dollars. So hello to all my viewers in the land of Oz. And as you can see here, the price of gold in Aussie dollars is up 96% over the last 5 years, which is significantly higher than the 70% it is up in US dollar terms over the same period. And that's because the Aussie dollar has simply devalued quicker than the US dollar. So with global national debts now exceeding $102 trillion for the first time ever, and the global economy, as I've said countless times before, certainly in a recession, we have entered a dangerous period of time where central banks around the world are implementing easy money policies and releasing stimulus into the global economy despite elevated levels of inflation. And this danger is no more obvious than when we look at the fact that the US Federal Reserve and other central banks have, for the first time since the disaster of 1974, started lowering interest rates with gold at an all-time high as measured in US dollars. Now, when I put all of that together, something tells me we're in for some major issues with currencies around the world in 2025 and 2026, and that's exactly what I want to talk about in this video, starting with the growing body of evidence I am seeing to suggest that massive currency devaluations and even crises are on the way. Once I've covered that, I want to talk about the impact on the US dollar and the prices of gold and silver. And this bit will be good for people who are trying to time the market in 2025, as I will show you a timeline of what I expect to happen. Once that's covered, I want to finish this video with a little bit of a follow-up from my work from 2 weeks ago about the Great Taking and answer a viewer question on what methods governments and institutions are going to use to get between you and your private property. So stay tuned till the end of the video for that, because I have a breaking development to talk about as it refers to that topic. Now, just before we dive in, I have a brand new article for you all to read at summitmetals.com, and it's all about physical metals versus ETFs. It includes interesting facts for you to consider when selecting between the two, like, did you know that ETFs don't always exactly track the spot price of gold and silver? So whether you want to learn more about that, or if you still want to get some silver at spot with the code NEWCUSTOMER, check out www.summitmetals.com for everything precious metals related. Okay, so diving in, we start in Japan, where since 2000, the Japanese national debt has gone from 135% of the country's GDP up to 264%. And for reference, the United States debt is 124% of the country's GDP. And this is an insane amount of debt that surely can't be paid back at this point, and has forced the Japanese central bank to keep interest rates extremely low. How low, do you ask? From 2016 to 2024, the interest rate in Japan was negative. That's how bad it is. As a result of that insane policy, the Japanese yen has gone from 76 yen to 1 US dollar in 2011 to nearly 160 yen to 1 US dollar today, over a period where the US dollar itself has devalued by 43% according to US government statistics, which means the Japanese yen has devalued at a minimum of 90% since 2011, and in reality probably closer to 150%. Now, you may call this a crisis, you may not call it a crisis, but I can tell you that I have noticed more and more Japanese viewers watching this channel since 2023 as this trend has accelerated. And if you're wondering if the Japanese government or central bank can do something to reverse this, the fact is there is little they can do. The last time they tried to raise interest rates, the Japanese stock market dumped by 25%, and the S&P 500 pulled back 9%, which was back in August of 2024, and I'm guessing many of you remember that because gold and silver also took a big hit when that happened. And that universal hit to assets around the world was driven by the fact that people have been borrowing Japanese yen at super low rates for years now and using it to gamble on the stock market, and that's what people are talking about when they mention the yen carry trade, because higher rates increase the cost of borrowed money in Japan and trigger sell-offs in the assets that gamblers bought with borrowed yen as they take the money out of the financial markets to pay their loans back. So with a healthy fear of crashing the markets and a nudge in the right direction from Uncle Sam in an election year, the Japanese are now sitting on their hands watching their currency rapidly devalue at the same time they are losing control over their bond market, which, as you can see here, has pushed bond rates up to the highest levels in 10 years, meaning it's not going to be easy to pay back that enormous $10 trillion debt the Japanese government is carrying without printing a lot of money to do it, which, despite taking a short break from printing money recently, shouldn't be an issue for the Japanese central bank considering their track record. Now, it's not only Japan that is feeling this pain, largely brought about by a demographic crisis and shrinking population. In fact, China is feeling it too, and as this article here hilariously put it, many people are comparing China's latest attempt to get back on track to the US Cash for Clunkers program, where in 2008 Americans received subsidies to trade in their old cars to buy new ones, which was supposed to stimulate the automotive sector. And the reason people are making that comparison is because that in part, that is what they are allowing people to do right now, and this latest announcement expands on that program to say households will be able to trade in 3 electronic devices to receive new ones at a steep discount. So now it's encompassing consumer goods, and it's why we saw relative strength in the price of silver at the end of last week despite a small pullback in the price of gold. Now, all of this stimulus has to come from somewhere, just like the money to pay back Japan's monster debt has to come from somewhere, and you'll be shocked to hear that it is coming from the same place, which is the Xerox machine, also known as the money printer, because as China borrows more and more money via special long-term bonds, which are seemingly less special with each new stimulus announcement they make, they are heavily adding to their M2 money supply. And that applies also to their debt to GDP ratio, which is set to increase even more than these projections here show, that suggest China will hit the magic 100% debt to GDP level as soon as 2027. But based on revised figures in the latest stimulus announcements they've made, I would assume that date now would be 2026. So as we switch over to an image of Eurozone money supply, and that counts countries that use the euro, that's what Eurozone means, I will say that the problems in a lot of these developed economies look the same. And of course, I talked about Germany's problems last week, but essentially it boils down to demographic issues made worse by very bad government decisions, which of course vary from country to country. But the one thing they all have in common is the solution to the problem, which is and always will be pump the system with more money. Now, would I call this a crisis today? Not yet, but it is becoming a growing problem that is strengthening the US dollar and reigniting inflation pressures outside of the United States, even more so than the obvious internal inflation pressures that exist within the United States. And as much as I was wrong on calling a major pullback in markets in 2024, I'll admit that, I think we are gearing up to see it in 2025 because of the shift in political incentive. Meaning that the outgoing Biden administration can no longer artificially prop markets up, and Donald Trump, knowing very well that the system needs to be cleaned out, will want that pain to start as early into his presidency as possible so he can pin the blame on Biden and eventually stimulate the economy to achieve a bounce back as well as deliver a weaker US dollar, which we know is an element of his economic strategy. Now to the exciting bit. You probably won't get this from other metals YouTubers, but I have a history of sticking my neck out here on the channel. My regular viewers will be very aware of that. And what you see here is a rough timeline of how I see the market correction playing out. And although the timeline may shift a bit during the course of the year, I expect to see the beginning of the correction in the first part of 2025, around the time Trump takes office, causing a flight of money out of paper assets into the US dollar, which will put pressure on gold and silver prices, not only because of US dollar strength, but also because in moments like this, everything sells off. That's just a fact. Nothing gets spared. And I'm not going to tell you a lie that, for example, this is the moment that metals fly, because the truth is, that comes later. And I have marked that moment at the end of 2025 when I expect to see a stronger reaction from central banks, including the Federal Reserve, meaning the 1 or 2 rate cuts currently expected in 2025 will likely turn into 4 or 6, with a high probability of US economic stimulus happening in the second part of the year, driving gold and silver prices up in a bit of a reverse 2024 scenario where prices rose in the middle of the year and then pulled back near the end of the year. What I am saying is that we may see the opposite of that in 2025. But as I have said before, it's nothing to worry about when we zoom out and take a look at the bigger picture, and it's why I'm not trying to get cute and sell my metals now to buy them back later, because as a reminder to you all, gold did not go below its 2007 pre-cut level when markets crashed in 2008. And with gold trading at $2,640 an ounce today, and considering that it was at $2,550 when the Fed cut rates back in September 24, that means, as I've shown you here, I see only marginal downside from here, and I think staying on a schedule, especially in the first half of 2025, is going to be important. And my reasoning for this becomes much clearer when we consider how much more quickly the Federal Reserve is intervening to prop up markets since the 2008 crash, and we saw that very well in March and April of 2023 when they stepped in to prop up US banks after the failure of Silicon Valley Bank. And if I can say a word in summary, it's a big old printing party all around the world, and it has been since 2008, and it's precisely why central banks are buying up gold, because they know their currencies are entering a period of rapid debasement. Now, we're going to touch on one of the solutions they are considering in the viewer question portion of this video, but whether you call this a crisis or not, we will see regional turmoil as a result of this and increased geopolitical issues as a consequence. Because if the Russian Revolution taught us anything, it's that people get uneasy when they have nothing, and all of that bodes well for precious metals. Now, with that covered, it's time to move on to this video's viewer question. And remember, if you have a question on anything I've discussed in this video, please make sure to leave it in the comments section below. You never know, I just may select your question to appear in my next video. And this week's question comes from All4, and they left this question under my video from a couple weeks ago on the topic of the Great Taking, where I covered my thoughts on the book you see here by David Rogers Webb that claims all assets will be taken by the government, and that citizens will be paid pennies on the dollar for those assets in the form of a CBDC, a central bank digital currency, resulting in full government and bank control over all assets. And what All4 wants to know in relation to that video is, how can governments and banks steal from people who own their property outright? And he mentions homes and cars as examples in his questions, asking how can they be taken? And although I don't fully agree with Mr. Webb's message from the book, what I will say is that the type of theft All4 is asking about, and this was my point in that video 2 weeks ago, is already happening before our very eyes via taxes, inflation, and the custody of assets by large banks and financial organizations. Now, where this problem potentially gets worse, and what I want to bring your attention to as a continuation of the main topic of this video, is something I first spoke about back in February 2023, and that is the tokenization of assets, which is already in its early stages of implementation. And I'm sure many of you are asking, what the heck is tokenization of assets? So, to make it as simple as possible for you all, it is when everything you own is cataloged and converted into what I can best describe as crypto tokens on the blockchain. Now, don't be thrown off by the term crypto. I am trying to make this as understandable as possible for you all. But tokenization is already happening in many asset classes, most famously art, where people can actually buy shares or tokens in expensive paintings and sell them at a profit when they're auctioned off, or just when there's more demand for the tokens in a specific painting. So when you hear tokenization, think of it as taking a real-world asset, splitting ownership of that into little bits or shares, and then having people trade and exchange them like cryptos on the blockchain. That is what we're talking about. And I know all of this sounds crazy, but what this essentially does is it makes every single thing you own an easily transferable asset, unlocking trillions in capital that is otherwise frozen today. And that includes your car, your home, your silver, your gold, making them all, as I said, as easily exchanged or spent on goods and services as it is to tap a credit card or hand over a banknote today. And although I struck an optimistic tone about this in 2023, what I want to say in response to all four is this topic is very much on the radar of organizations like the World Economic Forum, whose leader Klaus Schwab famously said, "You will own nothing and you will be happy," right? You all know that one. And they even put out this article in December of last year, so less than a month ago, which states that this idea is gaining momentum at an institutional and governmental level, and it seems they really like this idea. So why would that be? Well, this is where the confiscation bit comes into play, because if savings rates around the world are hitting all-time lows and credit card debt is skyrocketing to new highs as economies stagnate despite growing money supplies, it tells me the stimulation that money printing used to give the economy is wearing off, and that at some point soon, central banks simply won't be able to print enough money to stimulate because the newly printed money won't have any effect anymore, causing an economic death spiral. So instead of printing money to stimulate the economy, banks and organizations like the World Economic Forum want to bring new forms of money online that are backed up by real-world assets. Again, unlocking trillions in frozen capital. This will allow governments to feed their massive appetite for taxing and spending, giving them new opportunities to tax asset-based transactions that otherwise would never have existed. And this will give banks easier access to the equity you have in your personal property by allowing you to offer them up as collateral for loans that, as this data you can see here on the screen suggests, people are having a tough time paying back. All of which continues the already ongoing transfer of wealth from regular people to the government and large banks, not at all requiring an intricate, slow-moving 70-year plan like David Rogers Webb outlines in his book. Because politicians, bankers, and central banks are all impatient. They're not thinking 70 or 80 years out like Webb's book suggests, and I base that comment on the dates he cites for when this master plan he describes was first put into motion by people who, by the way, are no longer alive. People in power are looking for power and control today. They're looking for a payoff that they will see in their lifetime. And tokenization, which could be good for humanity, is one of the tools they will likely try to use to assert that power and control over us, knowing in advance that we will either abuse it out of lack of self-control or abuse it out of necessity to survive, all while allowing them to tax and steal in new ways made possible by technology. So, all four, if you're wondering how this can be done in a way that people may accept and maybe not even view as theft, this is how I see it being done. And although I think this has the potential to drive growth and investment in new ways, it also has the potential to harm and steal, so it's a real double-edged sword. With that said, that's it for this video. I want to wish you all a very happy and prosperous 2025 ahead. I hope you all succeed in everything that you want to achieve. I'm wishing you positivity in your life. I'm wishing you health. I'm wishing you happiness with your family and loved ones. And I want to thank you all for watching this video. If you enjoyed the content, please remember to leave a like. And if you think what I'm saying in this video is important and interesting, please share it with people who you think need to hear this message. So, as I finish all of my videos, I'm going to say, please remember to take care of yourselves and take care of each other. I'll see you all in the next video. Goodbye.